All right. So we're going to be analyzing a bank today. And as mentioned, right, the bank, so we're doing Atlantic Union Bank shares. Okay. And we're using a framework that we call CAPELS. Now, the original framework we developed this from is called CAMELS. All right. It's called CAMELS. This stands for capital adequacy, asset quality, management, earnings, liquidity, and sensitivity to market risks. Or let's just say sensitivity to risks. Okay. Now, in usual fashion, I made some adjustment here. I call it CAPELS, right? And so it's going to be capital adequacy, right? Asset quality. The P is going to be for potential, right? Earnings, liquidity, and sensitivity to risk. So everything else the same. We swapped out management for potential, right? And we'll get to that. Pretty much, it's just a list of things you go through, and we handle ours a little bit differently as well. What they would usually do is they would put a weight on certain elements here, and then create like a weighted score. Okay, but what we like to do is we like to create systems where everything has weight. So that way we don't have to decide, oh, a little more weight here, a little more weight there. Now, don't get me wrong. Don't get me wrong. When it's all said and done, um, in the case of like some of these companies that we're analyzing, if like things like ROIC are missing, just using that as an example, then yeah, that is a big deal. Okay. In terms of a bank, if they have a low return on equity, that might be considered a big deal, right? Stuff like that. All right. So yes, we do take those things into consideration, right? But we don't have to add extra weight to it in the actual score. Let's keep going. So I'm on the bank's website now. So I pulled up from FinViz. On FinViz, if you pull up, I found them in the screener that we use for the day. All right. Open them up in a new tab here. All right. We can close this out because I'm going to open a new one. Then if you click on the name of any company on FinViz, it will take you to that company's website. Now, from here, keeping it really simple, when you get to the bank's website, you want to go and find the investor relations. Okay. Once you find the investor relations, you can then look for things like SEC filings, financial info, that kind of stuff. Right. Um, we're going to try our best not to go straight to the SEC filings. Let's go to news and events, presentations, right? Earnings supplement. Is this what we're looking for? Let's see if this is how they do theirs. Okay, yeah. So usually in their earnings, they call it an earnings supplement for some reason. But it's just an earnings presentation, right? So they're the largest regional bank in this area, right? I like that. But this is not what we came here for, right? We came here to find all the things we're looking for, starting with what they call the common equity tier one ratio. All right, common equity tier one ratio. Let's see if we can find some of this stuff here. This is we're pretty deep in the report already. They don't seem to have it like right there. All right, let's see here. Mm-mm. Where we at? Where we at? Let me see something here. All right, here we go, right here. All right. What page is this? Page 15? Come on now, do better than that. All right. Your common equity tier one ratio of 6.5%. Now, we're just looking for 5%. I repeat, we were just looking for 5%. All right. Give me 1 second. Let me check on something really quickly here. Exxon. Okay, we got the change of character on Exxon. That's good. That's good. That's good. That's good. We got the change of character. Let's see if it sticks. All right. We'll see if it sticks. We'll come back around to that. All right. Just had to take a quick check at something real quick as I'm currently in a trade. All right. Now, so we got 6.5% on the common equity tier one ratio. So we're looking for 5% there. All right. So let's go to the chart here. AUB. Let's go back over here. All right, I'm gonna lay these things out like this, right? Okay. So we call it the CET1, right? We want it greater than 5%. Okay. Let's move this over a little bit. All right, we want the CET1 greater than 5%. That's your common equity tier one ratio. All right, we want it greater than 5%. Now, um, the next thing we're looking for is uh, we're looking for the allowance for loan losses, right? Or allowance for credit losses. So let's try this again. Let's do a little searching here. Right, here we go. Right here. So credit outlook. So ACL to loans. All right. Is 120 to 130 basis points. Net charge off is 15. All right. Basis points. Now we want the difference between these two, right? We want the difference between these two to be 2 or better, right? We want the difference between these two to be 2 or better. You can see it's far greater than 2. It's about 6, right? It's about 6 on the high end. I'm sorry, no, a little more than 6 on the high end, right? 130 to 20, right? Um, and even better on this end right here, right? So that's at 5, 6, about 6.5, right? Pretty much. All right. So we got that, right? We got that. That's good. All right. So we say ACL, so average allowance for credit losses, ACL to net charge-offs. We want this to be +2. Some banks may not report this. All right. Some banks may not report these things here, or may report a little differently. Okay. So what we would be looking for in that regard is we would just use sales growth as our other metric. So if we didn't have this metric here, if we didn't have this metric here, then we just use sales growth, right? If I couldn't find this information on the bank, I would just use sales growth. All right. Now it's time to get to the real nitty gritty. All right, we're going to go over the stock analysis. We're going to pull this bank up. All right, now we're going to get into these financial statements. We're going to go to the income statement. We're going to go to trailing 12 months. Okay. And let's see here. So this way you kind of get an idea. Okay, so interest income on loans. Okay, cool. All right, so we know we're dealing with a bank that so you see the net interest income right here is $871 million. You see their total non-interest income here is $180 million. So this tells me that this bank makes most of their money on interest income. So they're not really a big on services kind of bank. We'll get around to that in a second. They're more big on loans. So they make a lot of their money from loans, right? Now, so this is where you end up with a savings and loan, a narrative, right? Now, um, you see here I have provision for loan losses at 143 million, and I have here revenue before loan losses, right, at 1,052. I also have my revenue here at 908 million. Okay. So what I want to do is I want to take this number here, revenue before loan losses, and I want to use that to determine, how much revenue before loan losses am I dealing with here? All right, that's the first thing I want to do. So provisions is 143.45. I'm gonna divide that by my revenue before loan losses divided by 1052. And that's about 13.6%. It's cutting it close. I want that number to be below 15%. So loan loss to revenue, I want it to be below 15%. Look at Exxon. You see this? See that pullback that's happening right now? Now, as long as we're above this level, we're good. So we're gonna relax. All right. Okay. So let's see here. So loan loss to let's go back over here. AUB. All right. So loan loss to revenue. All right. I want that to be 15% or less. All right. Or let's just put less than 15%. Keep it simple. All right. This would be greater than 2. All right. Keeping it simple. All right. We'll come back around there. Now, the next thing we're going to look at is the loan to deposit ratio, but it's a few things I want to point out before we move on. Like, for example, as you can see here, right? The Q1 of 2024, this bank only had $28 million set aside for potential loan losses. By Q2 of 2025, they have $143 million set aside. Now that's pretty interesting, right? Because you're pretty much, I mean, this is a huge difference, right? So 28.01 divided by 712.2, I'd have 4% here. So they went from having 4% of their revenue set aside for loan losses to having 13%. All right, actually closer to almost 14%, 13.6% set aside. So this tells me this company between Q1 of 2024 and now, they see things a lot differently as far as the economy, as far as their customers are concerned, as far as the health of their bank is concerned. So you don't ignore the fact that they went from 4 to 14. You do not ignore that. Okay? Let me make that very, very clear. The other thing here is we know that they make most of their money on loans, right? What we want to do is we want to make sure that they're diversifying their revenue. So we want to see more non-interest income starting to work its way in over time. Right? We want to see more non-interest income working its way in over time. Okay? So that's what's been happening. All right? And non-interest income in most of these quarters, most of these periods, is outgrowing net interest income. That's also good. All right? I repeat, your non-interest income is outgrowing net interest income. That's also good. So that means that they're starting to, have more of their income based on services, right? Now, whatever those services are, you can look into that and so on and so forth. But you know, um, not gonna matter that much in the grand scheme of things. Now, the next thing we want to look for, right, is we want to look for a Fitch rating for this bank. All right, so let's see if they have a Fitch rating here. Atlantic Union Bank shares. Huh. KBRA. They have a KBRA ratings for Atlantic Bank share. Following acquisition. Okay. So this is for October 2024. So you're just looking for a credit rating overall, right? Just looking for a credit rating overall. So senior unsecured debt at triple B plus. All right, the preferred shares are triple B minus. Okay. Sandy Spring Bank announced Atlantic Union to acquire Sandy Spring in an all-stock transaction valued at approximately 1.6 billion. Pending deal will create a pro forma institution with $39 billion of assets, $32 billion of deposits. All right, and $30 billion of loans. Whoa. $32 billion deposits and $30 billion of loans. All right. Now, I would like my loan to deposit ratio to remain um, at about 80% ratio. All right. That's going to be healthy for me. So 30 divided by 32. So they have a loan to deposit ratio after this situation here of a 94%. Of a 94%. All right. Definitely not what I would like to see. Let's go to their balance sheet and see it for ourselves. All right. Okay. So it looks like their loans have come down here. All right. Gross loans here. Net loans 27 right here. Net loans 27. Where's my deposits at? Right here. So they've decreased it a little bit. They've decreased it a little bit here. But you can see they're used to playing this edge. All right. They're used to playing this edge here. All right. So they're a very aggressive lender. Okay. Y'all understand that? This means that they are a very aggressive lender. All right, give me a second here. Let me so their Fitch rating, look at Exxon go, baby. So their Fitch rating needs to be triple B, right? Or better. Loan to deposit. Well, let me actually here, hold on. Loan to deposit needs to be lower than 81%, pretty much, right? That's pretty much what we're saying. All right. Now the next thing, right? The next thing we wanna look at here, and you can do this in multiple ways, however you want to handle it, right? Is the earnings growth versus their peers. So I'm gonna come over here. I'm gonna go to regional bank. So let's make note of where their earnings growth is at. Look at this. So quarter over quarter, that's a no, right? Year over year, that's in the negative, right? You can see that. Okay. And their next 5 years projected growth is 14.84%. I use all three of these. Use all three of these. Now, we already have quarter over quarter and year over year in the negative. Right. So it's gonna be tough for them to get past this one here. Um and then loan to deposit ratio, I just can't get over that one. 94% is what it was when that transaction went through. Now it's about 27 over 30, which is still 90% anyway. Okay. So they pretty much brought it down to 90 from 94, which I guess is, it's an improvement. It's an improvement. It's an improvement. Here goes AUB right here. Right. So you have your earnings stuff here. So this year, right? Next year, past 5 years, right? And next 5 years. All right. So um let me go to financials here. And you could also look at the return on assets, right? Or return on equity to generate the strength. So pretty much I'm going to look at these five things. I'm going to do a comparative analysis on their earnings pretty much is what I'm doing. Okay. So just so we're clear on this here, we know that the past 5 years has been negative. We know that. Right? Past 5 years has been negative. All right. So they've seen their earnings declining. So and this says something, right? All that aggressive lending, all that aggressive lending, um, to be negative in earnings, and maybe that's why they're getting aggressive. Maybe who knows, right? Maybe they've been trying to play catch up. Right? Either way. So this year and next year, let's take a look at that, right? Earnings this year. Now we have 341 regional banks, by the way. There are 341 regional banks. So let's just be clear about that. Um, so that's about 18 pages. So we just need them to be. So what I can do is I can go to, like, let's say I go to page 8, right? So okay, so we know that they're in the top half of banks. Here they go right here. Boom. Right? Earnings per share next year, we got 20% there. I can just keep it simple. Let's go to page 10. All right. 9, 8. Let's go to 6 here. Let's go to 4. Okay, so I know they rank in the in the top 1/3. I know that much. They rank in the top 1/3 in this regard. Right. So that's good. Right. What about the next 5 years? Their earnings are projected to be 14.8%. Now I'm going to keep this one simple. I'm going to go to fundamentals, and I'm going to say earnings growth next 5 years. I'm going to say over 10%, and let's see how many companies disappear. All right, most companies disappear, so I know they're in the top 100 in that regard. So this is pretty good so far from an earnings perspective. Their past earnings definitely don't, lend any support to their case, and especially not when they haven't had the earnings, right? So return on equity 5%, definitely seems low compared to some of the numbers we're seeing here. But let's keep it simple. Return on equity over 5%. See what happens. Okay, 267 companies. So right out the gate, they're not. This isn't exceptional at all. Right? It's not exceptional at all. Now, uh, granted, if we're gonna, be, fair and impartial here, earnings per share this year, next year, and the next 5 years are outpacing a large number of their competitors here. Okay. So, you say, okay, cool, that's great, right? So earnings per share growth versus their peers is what you're doing next here, right? So, give me 1 second here, actually. 1 second, guys. Okay. So EPS growth. And it's just a comparative analysis. You can, interpret away on that. All right. You're just doing a comparative analysis. How well are they doing in comparison to their peer group as far as like earnings growth is concerned? They're not doing poorly. They're not the best, but they're not doing poorly either. All right. We already looked at the return on equity versus their peers. All right. So their earnings growth versus peers was good. The return on equity versus their peers was not. All right. Pretty much anybody in that industry can get that return on equity is what it seems. Like anybody and everybody can get that return on equity. It seems. Um, the next is their pace grade. Um, you can find that on your class model. All right, let's go over here. Okay. So it's 20%. That's excellent. All right, and that's actually what we're looking for. We're looking for a pace grade over 20%. Well, over 15% we're looking for, right? Pace over 15%. All right, so that's good. And then last but not least, are their earnings trending higher? Right? Last but not least, are their earnings trending higher? All right. Just go here. It's been pretty much, stagnant here. I guess over the past 30 days, they've seen it pick back up a little bit. So we'll give it to them. All right. So this is your EPS revisions. All right. I guess we go for the current state of it. The current state of their earnings revisions is positive. All right. So they got this. That's one. All right, so you have 1, 2, 3, 4, 5, 6, 7, 8, 9 points possible here. All right. So your common equity tier one, they were good there. Their net charge off ratio, they were good there. Loan loss to revenue, they were fine. It was a little tight, but they were fine. Now, loan to deposit, that's where we had our first issue. All right, that's where we had our first issue. Well, actually, our first issue came with the loan loss to revenue, where although they had the ratio that we was looking for, right? Although they had that, I think the big issue there was that the company, all in all, um, they've been increasing their loan loss provisions um, dramatically over the past year, which says that let me see here. Let me give you guys. I'm going to read this to you guys here, right? Um, so. Mm, so if a higher portion of a bank's total revenue is being set aside for covering potential credit losses, this is a sign of one of the two things, of one of two things, both of which require investigation. Either one, there's a deterioration of the loan portfolio, right? So this could indicate that the bank is making riskier loans or that the credit quality of its existing portfolio is declining. The bank is recognizing a higher probability of defaults, which forces it to set aside more of the revenue to a loan loss reserve. This can be a shift towards a more aggressive lending strategy or a signal of poor risk management. Right? Now, there's also part two, the anticipation of a recession. Banks tend to increase their loan loss provisions in anticipation of an economic downturn. If the ratio is spiking across the entire banking sector, right, it could signal that bank management teams are expecting a recession and are proactively building their reserves to absorb future losses. A sudden and significant increase in this ratio is 1 quarter to the next. In 1 quarter to the next is a key indicator of this proactive measure. Right? Now, 15% or lower would be a sign of a well-run bank with strong earnings quality, indicates the bank is managing its credit risk effectively and its loan loss provisions are not eating up a large portion of total revenue. Banks with higher fee-based income or low-risk loans like mortgages are more likely to have a healthy ratio. Right? Now, again, the bigger issue here is this increase, and so you still have to say either their loan loss, either their loans are deteriorating in value, right, or they're making riskier loans and have to set aside more money just in case. Now, we see that their loan to deposit ratio is very aggressive. So I can only assume that one of these two things is true. I have no choice but to make that assumption, which is why we check the loan to deposit ratio right after. Right now, if their loan to deposit ratio was 80% or lower, let's say it was more like 70%, right? Then I'd be like, okay, maybe they're just preparing for some sort of a. Now, don't get me wrong, it could still be that their loan portfolio is deteriorating, but they have a lot of deposits set aside to make up for that. Okay. In this particular case, so a bank must have adequate capital to absorb losses. And that capital's effectiveness is tied to the asset quality of its loan portfolio. So liquidity ensures that the bank can meet its short-term obligations like withdrawals and interest payments. A bank must maintain a strong capital buffer to absorb unforeseen losses and maintain solvency. Right? Banks build capital buffers by retaining a portion of earnings rather than paying them out as dividends or issuing new stock. Right? Now, the allowance for credit losses is used to absorb expected loan losses. If those losses exceed the amount in the allowance for credit losses, the bank's capital buffer must be used to cover the shortfall. Right? So in this particular case, we're talking about the bank's retained earnings. Let's come back over here real quick. All right, you see they have retained earnings right where that right here. All right, and you want this to continue to be rising. Right, you want this number continuously moving higher. All right, and when you start to see a drawdown in retained earnings, you might be a little suspicious, but not always. All right. Now, their credit rating comes next. As long as that's good, you're good. Earnings per share growth versus their peers, return on equity versus their peers, your PACE grade, which is your return on equity plus your projected growth and your earnings revisions, right? So with all of these things combined, you can tell whether or not you have a quality bank or not. All right. And then your outlook can be based on several of these factors. I think we do have a healthy bank at the moment. I believe we do. But these two elements here and here, right, make me say, you know what? I'd rather stand on the sideline and wait to see what happens with this bank than to be somebody that's involved, right? When it comes down to it, if I take a greater risk, I'm targeting a greater reward. But I don't want to play the risk to reward game in banking. Okay. Don't get me. Let me rephrase that. Right. I'd be more cautious taking the risk to reward route in banking. It's like saying I want to invest in this bank because they're doing aggressive lending. That's pretty much what you're saying if you're going for the high risk to reward here. I want to invest in this bank because they do aggressive lending. That's what you would be saying. For me, I want to avoid this bank because they're doing such aggressive lending and because their provisions for loan losses has skyrocketed over the past year while lending aggressively. I can't propose to be the person that can understand whether or not these guys are doing a great job or not. I don't want to be that person to have to make that decision. I'm just being honest. Okay? Plain and simple. They're lending aggressively and they're increasing their provision for loan losses as if they're preparing for some of these aggressive loans to go into default. Now maybe they have a large, share for commercial real estate. Let's check it out. Let's see what we find here. Commercial. All right, here we go. Commercial real estate. Okay. So it's only about 4%. Let's see, 60% here. Class. So percentage of the so yeah, so commercial real estate is about 60% of their portfolio. How did I know that? How did I know this? How did I know this? Commercial real estate is about 60% of their portfolios. They're a large commercial real estate lender. How was I able to tell that, right? Because the reason I was able to tell is because there's no way your loan portfolio is deteriorating that quickly. It just makes no sense for your loan portfolio to be getting dragged like that. Okay? That's how I was able to tell. All right. So there you have it. If you know, you know. If you understand how to analyze the bank, you could do what I just did, which is put two and two together, and boom, I could tell it must be the loan quality. It must be the loans themselves. These guys are likely not preparing for a recession, especially since every bank all over the place is not doing the same thing. So then I go and I check their portfolio and I find out, boom, these guys are heavy commercial real estate lenders. And I don't want any parts of it. That's the end of the story. I'll see you next time.